On September 14, 2008, a Sunday evening, the most powerful bankers in the world sat inside the Federal Reserve Bank of New York on Liberty Street and made a decision that would detonate the global economy. They decided to do nothing. Lehman Brothers, 158 years old, the fourth largest investment bank in the United States, a firm that had survived the Civil War, 2 world wars, the Great Depression, the savings and loan crisis, and the dot-com collapse, was allowed to die. Not over months, not over quarters, not even over weeks. Over a single weekend, while the rest of America slept. The next morning, markets from Tokyo to London to Frankfurt went into freefall. The Dow Jones Industrial Average lost 504 points in a single session, its largest single-day point drop since the day markets reopened after September 11th. The Nikkei fell 4.9%. The FTSE dropped 3.9%. Global credit froze solid, almost overnight. Companies that had nothing whatsoever to do with Wall Street, manufacturers in Ohio, retailers in Texas, small exporters in the Pacific Northwest, suddenly couldn't borrow the short-term cash they needed just to make payroll. The shockwave from one firm's collapse traveled so fast and so far that economists are still calculating the full damage today, 16 years later. But here's what makes this story more than just a financial disaster. Lehman Brothers didn't stumble into catastrophe. They ran toward it, deliberately, with both eyes open. And the people at the top knew exactly what they were doing, or believed with a certainty that bordered on religious conviction that they did. The question that still haunts this story isn't how Lehman failed, it's why no one stopped it. Henry Lehman arrived in Mobile, Alabama in 1844 carrying almost nothing, a few possessions, a working knowledge of German, and the kind of immigrant hunger that doesn't take no for an answer. He was 23 years old, the son of a cattle merchant from Rimpar, Bavaria, and he set up a small dry goods store on the main commercial strip of the city, not far from the docks where cotton bales moved in and out in the heavy Gulf Coast heat. He sold fabric, flour, tools, and provisions to local cotton farmers, but those farmers rarely had hard cash. The plantation economy ran on credit and commodity. So Henry started accepting raw cotton as payment instead of money, storing it in the back of his shop, then selling it onward when prices were favorable. That single improvisation, the willingness to take on a commodity when the conventional form of payment wasn't available, was the founding logic of Lehman Brothers. Not safety, not caution, flexibility in the face of risk. His brothers Emanuel and Mayer joined him, and by 1858, the firm had relocated to New York, setting up offices in Lower Manhattan and pivoting entirely away from dry goods and into commodity brokering and finance. They survived the Civil War by maintaining working relationships on both sides of the conflict. They financed the westward expansion of the railroads. They helped bring public companies like Woolworth, Macy's, Sears, and B.F. Goodrich to the stock market, underwriting the offerings that made those names into national institutions. They were founding members of the New York Cotton Exchange, established in 1871. For a firm that started with bolts of cloth and a back room full of cotton in Mobile, Alabama, the trajectory was almost absurd in its ambition. By the early 20th century, Lehman Brothers was a name synonymous with resilience and reinvention. It had navigated the panic of 1907. It had survived 1929, when the collapse of the stock market wiped out countless firms that had been household names the week before. It had endured the grinding, decade-long punishment of the Great Depression, when unemployment hit 25% and the entire architecture of American finance had to be rebuilt from scratch. It had survived a near-fatal internal collapse in 1984, when bitter infighting between the trading desk and the banking division became so corrosive that the firm was sold to Shearson American Express just to stop the bleeding. Each time, Lehman came back. Each time, the story reinforced the mythology. This firm does not die. It bends, it transforms, but it does not break. That mythology would become its most dangerous asset. By the mid-2000s, Lehman Brothers was printing money at a scale that seemed almost too good to examine closely. Under CEO Dick Fold, known internally as the Gorilla, a nickname he had held since his days trading commercial paper on the firm's bond desk, Lehman had transformed itself into a real estate machine unlike anything in its history. Not just financing real estate deals for clients, actually owning the assets directly. The firm had made a fundamental strategic shift from an advisory and brokerage model to a principal investor model, meaning Lehman wasn't simply arranging transactions and collecting fees. It was putting its own capital on the table, billions of its own dollars, borrowed, leveraged, and compounded many times over, piled into commercial real estate developments, residential mortgage-backed securities, collateralized debt obligations, and leveraged loans to private equity buyouts. In 2007, Lehman reported record revenues of $59 billion and net income of $4.2 billion. The firm's stock traded above $65 a share. On paper, this was the single greatest moment in the firm's 163-year history. Dick Fold collected $22 million in compensation that year. The executive floor at Lehman's headquarters at 745 7th Avenue in Midtown Manhattan, all gleaming glass and angular modernist confidence, 31 stories above Times Square, hummed with the kind of certainty that stops sounding like confidence and starts sounding like something else entirely. Something that doesn't have a polite name in a boardroom. What the public didn't know, what even some senior executives inside 745 7th Avenue didn't fully understand, was the leverage ratio embedded in that record-breaking success. For every single dollar of equity Lehman actually owned outright, it had borrowed roughly 31 more, a leverage ratio of 31 to 1. In plain terms, a decline of just 3.2% in the value of its asset portfolio would mathematically wipe out every dollar of equity the firm possessed. Not most of it, all of it. And the assets they had borrowed all that money to buy were starting to crack along invisible fault lines that the firm's own risk models were not built to detect. The U.S. housing market peaked in early 2006. By mid-2007, delinquency rates on subprime mortgages were climbing in patterns that the mathematical models, the elegant Nobel Prize-adjacent quantitative models that every major bank on Wall Street relied upon, had declared essentially statistically impossible. Those models were built on historical data from the previous 4 decades of American real estate. They assumed that housing prices across different geographic regions of the country could not all decline simultaneously, because local economies were diverse, because the shocks that hurt Detroit wouldn't necessarily hurt Phoenix or Miami. That assumption was not just wrong, it was catastrophically, fatally wrong. The models had never been tested against a synchronized national collapse driven by a single underlying cause. Predatory lending, fraudulent documentation, and financial instruments so complex that almost no one buying them fully understood what was inside. Inside Lehman, there were people who saw this coming with uncomfortable clarity. Mike Gelband, the head of fixed income, raised formal, documented alarms about the firm's mounting real estate exposure as early as 2006, when the housing market was still technically rising. His warnings went up the chain. They were acknowledged. Then they were minimized. Then he was pushed out of the firm in 2007, replaced by someone whose view of the real estate market aligned more comfortably with Dick Fold's own conviction. The message was not subtle. The firm's position on real estate was not a subject for open debate. So in 2007, as the mortgage market began to deteriorate visibly and publicly, as Bear Stearns' internal hedge funds collapsed in July, as the term subprime crisis entered the daily news cycle, Lehman did the opposite of pulling back. They doubled down. They increased their commercial real estate holdings to over $40 billion. They acquired the mortgage lender BNC Mortgage and the commercial real estate lender Aurora Loan Services, bringing the very source of the problem directly onto their own balance sheet. The internal logic was straightforward. Everyone else is panicking, which means prices are temporarily depressed, which means we are buying quality assets at a discount, which means when the market stabilizes, we profit, while our competitors, who sold at the bottom, have nothing left. Dick Fuld had deployed this exact counter-cyclical logic during the Russian debt crisis and the LTCM collapse in 1998. He had used it again after the dot-com bust in 2001. Both times the firm emerged stronger than before. The strategy had a real track record built over real market cycles. What had changed, invisibly, fundamentally, was the nature and scale of the exposure, and the fact that this time the assets underneath the trade were not temporarily depressed. They were structurally impaired. By the first quarter of 2008, Bear Stearns, another storied Wall Street institution with deep real estate exposure, 85 years old, employing 14,000 people, had collapsed over a single weekend in March and been absorbed by J.P. Morgan Chase at a fire sale price of $2 per share, with the Federal Reserve guaranteeing $29 billion in Bear's troubled assets to make the deal happen. The message from Washington seemed clear, almost explicit. The federal government would not allow a major financial institution to fail outright. The systemic risk was too great. The interconnections were too deep and too complex. There was an invisible floor beneath the largest firms, and the government had just demonstrated it was real. Lehman's senior leadership interpreted the Bear Stearns rescue as confirmation that this floor existed for them too. If Bear Stearns got a backstop, Lehman, larger, older, more central to the global financial system, would certainly get one. This belief became the operating assumption inside 745 7th Avenue through the entire summer of 2008. It was almost certainly the single most consequential miscalculation in modern financial history, and it was made by intelligent, experienced people who had excellent historical reasons to believe it. Through June, July, and August of 2008, Lehman was hemorrhaging in ways that were becoming impossible to hide. Counterparties, the banks, prime brokers, hedge funds, and money market funds that did business with Lehman every day through thousands of daily transactions, were growing nervous. And nervousness in finance is contagious in a way that nervousness in almost no other industry can replicate. Because the entire financial system is not ultimately built on capital. It is built on confidence. The moment counterparties begin to doubt whether an institution can honor its obligations, they start pulling back their business. They reduce their exposure. They demand more collateral. And the moment they do that collectively, the institution's liquidity evaporates, which means it actually cannot honor its obligations. The fear manufactures the fact it was afraid of. Lehman's stock, which had traded above $65 per share at the start of 2008, fell below $20 in August. By September 9th, after a report that Korean Development Bank talks had definitively collapsed, the stock fell to $7.79 in a single day's trading, a drop of 45% in one session. In 9 months, the firm had lost nearly 90% of its market capitalization, while its leadership continued to insist on earnings calls, in press releases, and in private conversations with investors that the firm was adequately capitalized and that the real estate positions were being actively managed. Dick Fuld was not a stupid man. He was, by most accounts from people who worked with him closely, one of the more operationally sophisticated CEOs to run a major Wall Street firm in the modern era. Someone who understood the bond markets with genuine depth and who had built Lehman into an independent powerhouse after Shearson spun it off in 1994. But he was also a man of extraordinary, almost geological certainty in his own judgment, and that certainty had gradually insulated him from the one thing that might have saved the firm in time: genuine, unfiltered, unmediated information about how catastrophically bad the situation had actually become. Inside Lehman, the organizational culture around bad news had calcified in ways that are now well documented in congressional testimony, court filings, and the accounts of dozens of former employees. Executives who brought troubling risk assessments were known to encounter a reception that made bringing troubling risk assessments seem professionally unwise. Quarterly earnings calls were crafted with surgical care to project stability and control. Internal risk reports went through layers of review before reaching senior leadership. An accounting technique, later nicknamed Repo 105, examined extensively by bankruptcy examiner Anton Valukas in his 2,200-page post-collapse report, was used to temporarily move as much as $50 billion in troubled assets off Lehman's balance sheet at the end of reporting quarters, making the firm's leverage ratio appear healthier than it was. This is a pattern that appears with remarkable consistency in virtually every major corporate collapse in modern business history. Not necessarily deliberate, orchestrated fraud at every level, but an organizational immune system that rejects bad news before it can travel upward far enough to matter. In August and September 2008, two potential rescues came agonizingly close to working. Korea Development Bank held serious, detailed discussions about acquiring a 25% stake in Lehman for approximately $6 billion. The talks proceeded far enough that Lehman's stock temporarily recovered on the rumors. They collapsed over valuation. Lehman wanted more than the Koreans would pay, and the gap proved unbridgeable. Then Barclays, the British banking giant, engaged in intensive acquisition talks during the final crisis weekend itself. Barclays was genuinely willing. Its CEO, John Varley, and President Bob Diamond were at the table. But British financial regulators, the Financial Services Authority, would not authorize the transaction on an emergency basis without a shareholder vote, a process that would take weeks that simply no longer existed. The clock ran out before the paperwork could. On the night of September 13th and into the early hours of the 14th, Treasury Secretary Hank Paulson, New York Federal Reserve President Tim Geithner, and the CEOs of every major surviving Wall Street firm gathered inside the spare institutional conference rooms of the Federal Reserve Building on Liberty Street in Lower Manhattan. The meeting ran through the night, fueled by cold coffee and the growing awareness that there was no solution coming. Paulson had already made his core decision. There would be no government capital injection for Lehman Brothers. The political environment after the Bear Stearns rescue, the public fury, the congressional pressure, the accusations of Wall Street favoritism, had made another taxpayer-backed deal politically impossible to execute or defend. He needed the private sector to collectively absorb or assume Lehman's positions. By Sunday morning, with Barclays blocked and no American buyer willing to act without government guarantees, it was clear the private sector would not and could not do it alone. At 1:45 in the morning on September 15, 2008, Lehman Brothers Holdings filed for Chapter 11 bankruptcy protection in the United States Bankruptcy Court for the Southern District of New York. It was the largest bankruptcy filing in American history. $613 billion in declared debt, 25,000 employees across 26 countries, a global web of counterparty relationships touching virtually every major financial institution on Earth, all of it frozen in place by a legal filing that took minutes to execute and seconds to transmit. The 158-year-old institution that had started with cotton bales stacked in the back of a store in Mobile, Alabama, ended with a court document filed in Lower Manhattan before the city had even woken up. The immediate aftermath moved at a velocity that no one, not the regulators, not the Treasury, not even the people who had been warning about systemic risk for 2 years, had fully anticipated or prepared for. The Reserve Primary Fund, a money market fund managing $62 billion in assets that millions of ordinary American households used as a safe, boring alternative to bank savings accounts, held $785 million in Lehman Brothers commercial paper. Within 24 hours of the bankruptcy filing, the fund broke the buck, meaning its net asset value fell below $1 per share, something that had happened only once before in the entire history of the money market fund industry. The result was immediate global panic. Investors began redeeming money market funds everywhere, simultaneously, pulling nearly $200 billion out of prime money market funds in the week following Lehman's collapse. Companies across the American economy lost access to the commercial paper markets they depended on for short-term operational financing. The credit freeze wasn't a metaphor or a financial abstraction. It was a physical reality with physical consequences. For approximately 2 weeks in late September 2008, the machinery that keeps the modern economy running, the overnight repo loans, the commercial paper markets, the interbank lending networks, the letters of credit that allow goods to move across borders, essentially stopped functioning. The U.S. government ultimately committed over $700 billion through the Troubled Asset Relief Program to stabilize the banking system. The Federal Reserve expanded its balance sheet by trillions of dollars and took emergency actions that had no precedent in its 100-year history. The global recession that followed cost the world economy an estimated $22 trillion in lost household wealth and foregone economic output, according to the U.S. Government Accountability Office. Millions of American families lost their homes to foreclosure. Unemployment in the United States peaked at 10% in October 2009, representing roughly 15 million people out of work. Countries in Eastern Europe, Southeast Asia, and Latin America, countries that had not issued a single subprime mortgage, had never heard of a collateralized debt obligation, watched their export markets collapse because the financial system that connected the world had been allowed to run through a single, catastrophic point of failure. 30,000 lawsuits were filed in the aftermath of Lehman's collapse against the firm, its officers, its directors, its auditors, and its underwriters. Dick Fuld testified before the House Oversight Committee in October 2008. Seated alone at the witness table in a congressional hearing room, under the cameras and the lights, he told the committee that he had searched his own conscience every single night, asking what he could have done differently. He said he found nothing. He said he was proud of the decisions he and his team had made and would make them again. No senior Lehman Brothers executive was ever criminally charged in connection with the firm's collapse. The firm that Henry Lehman built on the principle of flexibility, on the willingness to take cotton when cash wasn't available, to read the moment, to find a path through when convention offered none, died because its final leadership could not adapt to the single most critical reality of 2007 and 2008, that the world had genuinely changed, that the models were wrong, that the bet that had made them wealthy beyond measure was now making them insolvent, and that the floor they believed in did not exist. The lesson of Lehman Brothers isn't that risk is dangerous. Risk is the entire point of finance. The lesson is something quieter and more universal. When an institution builds a culture where bad news cannot travel upward, the news doesn't stop being bad. It just stops being heard. And by the time the silence finally breaks, when the debt is $613 billion and the lawyers are on the phone and it's a Sunday night in September, there is nothing left to do but sign the paper. If this story kept you thinking, you know what to do. Subscribe to Corporate Autopsy, because every week we open another file.